Good morning, everyone. Thank you for joining this session. I think the attendees are increasing 185, 186. Let's wait for 1-2 minutes and we can start the session. So let's start the session. I am, as a matter of brief introduction, I am Rakesh Nair. I'm a director with Crow and I'm leading the corporate tax practice. I have with me my fellow team members Rohit Kejriwal and Aditya Bhartiya, and I would like to thank them for taking their time out to share their knowledge. Before we proceed with the agenda for today's webinar, few housekeeping matters. We would be recording this webinar and it will be uploaded in our website soon. If you have any questions, you can put it in the chat box. My fellow team member Nishant Raima is noting down all the questions and we will take up the questions at the end. There will be a feedback form which will be circulated. Please provide your feedback. So moving to the agenda, as you would be aware that this is the last corporate tax free months before the corporate tax comes into effect. And we have the privilege to be part and to be witnessing this new law coming into force. To ensure that our clients are ready with the challenges and ready to meet the challenges and take up the opportunity, we have structured the session in a way that we will first cover the key practical consideration while gearing up for the corporate tax, which will be taken by my fellow team member Rohit. And subsequently, we will be taking up ESR, considering that the ESR notification timeline is fast approaching. With this background, I will hand over the space to Rohit Kejriwal. Rohit, over to you.
Hi, good morning to all the attendees. Thanks a lot, Rakesh, for setting up the tone. So, the next slide, please. Next. So, as UAE is a signatory to the OECD BEPS including framework, it has introduced corporate tax in UAE at the rate of 9%. As you must be aware that the corporate tax is effective for financial year for on or after 1st June 2023 and it's applicable for the financial year starting after 1st June 2023 onwards. So many a times what are the most financial year that is applicable for all the entities is January to December in the UAE. So the first year of applicability or the implementation of corporate tax law for the entities over here is 1st January 2024 onwards, and July to the December 23 is something for when the corporate tax would not be applicable in case the financial year is January to December. So many a times which we have made the clients, we have seen that the clients are basically procrastinating the implementation of corporate tax law because in the system, because of the fact that the thinking that the implementation for them is from 1st January 2024 onwards. However, it is very imperative right now to ensure that all the actions, activities, entries that they are making in the financial statements are in line with the corporate tax law, given the fact that 2023 would be the first comparative year for the tax authorities, and in case there is any increase or decrease or substantial modification in the nomenclature of the expense or the items that are booked in the financial statement, then there may be certain adjustments that may be made by the tax authorities. So that is very much important that the preparedness for the corporate tax law should be made right away without further delay so as to avoid any undue tax adjustment by the tax authority in the future. So these are some of the points that can be construed or keep it in mind right now in order to make preparedness for the corporate tax. First is using the right nomenclature of the expenses in the financial statement. Why this is very important? Because there are certain expenses which are disallowable in the financial as per the corporate tax law, and if the expenses are incurred for some other purpose and are recorded in some other way which attracts potential disallowance, then there may be some issues. Like suppose if a company is incurring expenses for business promotion purpose and those are considered the advertising expense, but the same are being booked under the head of entertainment expense. Now, as per Article 32 of the Corporate Tax Law, the entertainment expenses exceeding 50% are disallowable in the corporate tax computation. So even if you have incurred the expenses for the purpose of business or for the purpose of business promotion, then the same year may be disallowed as entertainment expense by the tax authority. So it's very important to critically analyze each and every item in the appearing in the financial statement. And also there is one more thing about director remuneration. Many a times we have seen that the companies are paying remuneration to the directors, but the same are sometimes booked as management service fees. So the documentation that is required for management service fees is different from what is required for a director remuneration. For director remuneration, you do not need to have a service agreement. However, for a management service fee, service agreement is very much required. So when you are having a service agreement, so if you are booking an expense as a management service fee, you need to have a service agreement in place. However, the same is not required in case of director remuneration. So what we have seen that the clients are booking director remuneration as management service fees, and when they are, and if suppose the same is taken up during the course of assessment, so the tax officer will be asking for the service agreements and all, which the clients won't be having. So again, there may be a difficulty in substantiating the amount of expense. And many a times in the director remuneration, also we need to be cautious that while there is also a limit specified in the company law, Article 171 of the company law, which says that the director remuneration should be limited to 10% of the net profit of the company. So if the so those again the thing that is specified in the company law for the director remuneration part. The second is maintenance of documentation, agreements, invoices, and emails. So many a times the expenses that are booked in the financial, there are no supporting agreements or the invoices in place by the company because of whatever tendencies that the company is following out for the long period of time. But now, after implementation of corporate tax law, it's very imperative that all the expenses are duly backed up by the invoices, by the agreements, because those can be asked by the tax authority during the process of assessment proceeding. And also, even if you do not have the audit requirement, like or there's as per ministerial decision 82, there's two types of entities for which the audit requirement is specified. One is the qualifying free zone and the other is 200 million to 50 million turnover for the entity. But then also, even if the audit is not required, you need to have all the documents in place, all the supporting document in place, because that can be asked by the tax authority at any point of time. Further, there is also a period specified under the tax law for maintaining the documents, which is 7 years from the end of the financial year. So the company needs to be cautious that during the entire period of 7 to 8 years, the documents should be in place and they are able to substantiate the same before the tax authority in case required in future. Third point is the financial statement as per applicable accounting standard. Many a times we have seen that the companies over here in UAE do not have sufficient the accounting standard in place for preparation of the financial statement, as a result of which the financial statements are prepared in some Excel format, in some Tally format, but those are not taken into account the accounting standards that are prevalent over here. And as per the corporate tax law, the accounting standard that is the needs to be followed is accounting standard as per applicable in the state, which is IFRS in the given case. So even before, whatever types of financial statement was prepared by the companies, that was okay. But now from a corporate tax standpoint, all the accounting systems needs to take into account the IFRS accounting standards, and all the entries needs to be passed in accordance with that. Then strong internal accounting system. So a company needs to have a strong internal accounting system so that it bifurcates whatever expenses are incurred for exempt income or the whatever are expenses are income for non-exempt income, because in the tax law the expenses incurred for exempt income are disallowed. So at the time of booking of expenses, it's very important to segregate all the expenses for exempt item and non-exempt item, so that when the computation is prepared, there is no anomaly in that. And further, like even for qualifying and non-qualifying income for a free zone, the expenses and the expenses are bifurcated duly for qualifying income and non-qualifying income. The last but not the least, the most important point over here is the arm's length pricing for the related party transactions. So there, under Article 61, Clause 2 of the Corporate Tax Law, it's mentioned that the opening balance sheet for the entity needs to be prepared as per taken into account that the related party balances takes into account the arm's length pricing. What it means that even if the corporate tax law is implemented from 2024, whatever balances of related parties are appearing in the balance sheet for 2023, those needs to be reinstated, taking into account the arm's length pricing for the TPA regulations. Now we have been approached by a lot of clients that there are a lot of related party balances appearing in their balance sheet, and how to reinstate that. Now again, that is a very one of the thing that can be done is the knocking of the related party balances. So if possible by the entity, the knocking of the balances may be done. And there are other things also which we can talk separately as to how we can do the arm's length pricing for the related party balances. The next slide, please. Next. Yeah. So the 9%, the corporate tax is levied not on the net profit that is appearing in the financial statement. The 9% is levied on the taxable income that is computed taking into account the provisions of the corporate tax law. Many a times what we have seen that the company just thinks that okay, it's 9% on the net profit, pay 9% and your responsibility goes. It's not like that. You need to have a proper taxable income computed as per the provisions of tax law, and there is a journey that needs to be taken from a net profit to the computation of taxable income, and here are the adjustments that are specified therein. The first adjustment over here is the capital and revenue expenditure. So whatever expenditure are being incurred by the company, those can be revenue expenditure as well as capital expenditure. Capital expenditure are those which provides enduring benefit to the company, and those benefits are provided beyond a particular tax period. However, the revenue expenditure are those expenditure those for which the benefits are derived to the company for a single year. Then there is thin capitalization rule, which talks about that any interest expenditure which is beyond 30% of the EBITDA, that again will be disallowed. In this particular thing, so whatever thing is provision is given that even if those are disallowed, there is a provision to carry forward that interest disallowed for a period of 10 years, whatever the interest is disallowed. Then entertainment expenditure, as discussed earlier, there is the entertainment expenditure exceeding 50% are disallowed. Then there is irrecoverable VAT. Irrecoverable VAT means whatever any input VAT is there for which you are not able to claim that thing because of due to non-filing or delayed filing of the VAT return, then the same needs to be disallowed. The same is allowable, but any amount of VAT which you are recoverable, that is generally disallowed. Means you cannot claim a credit of that. Only the credit can be claimed of only the deduction can be claimed of VAT which is not recoverable by from the tax authority. Then payment to connected persons aligned with the TP provisions. So as per Article 36 of the Corporate Tax Law, it's specified that whatever payments we are making to the connected persons, which means owners, directors of the company, needs to be as per the market price. So what is market price is specified that is as per the arm's length pricing. So whatever payments now is being made to the directors, be what can be seeming okay to the company, that might not be seen appropriate as per the benchmarking principles. So whatever efforts a director is putting to the company, that needs to be, its salary needs to be commensurate to that level. And because there are many directors who are not functioning day to day, there are many directors who are withdrawing salary which is beyond what is their thing. So those all things, because this is very peculiar thing, as there is no personal income tax, so there may be a tendency that a director or the owner is booking more amount as expenses so that the company gets a deduction of it. However, the ultimately the personal tax is not there, so those tax not be paid. So it's very critical that whatever payments are being made to the directors and owners of the company right now, all those things needs to be a benchmarking analysis needs to be undertaken in it, and going forward all those payments needs to be as per the arm's length pricing that has been determined for it. Now determining the arm's length pricing for a director remuneration is really a very cumbersome exercise, and we do have relevant softwares and all to do the relevant benchmarking for it, and we recommend clients to undertake those kind of benchmarking for these transactions as well. And what are the non-deductible items? One is the non-business expense. So we need to see that whatever expenses we are incurring, that needs to have a business commercial expediency. What is the tendency nowadays that most of the personal expenses of owners are even clubbed with the financial of the entity, which really would not be possible going forward. So suppose if an owner is going for a foreign trip or so those will be disallowed, stating that it's for the personal expenses and it's not for the business expense. Now the exempt income expense, so any expense incurred for the earning of exempt income, that will be disallowed. Any donations, gifts to unqualifying public benefit entity. So there was a list of the qualifying public benefit entities which was released by the FTA, and only the donations, gifts which we are giving to those entities will be allowed, and all other donations will be disallowed. Fines, penalties. So any fines, penalties, suppose there is any VAT penalty that has been levied by the tax authority, that will be disallowed. And income tax imposed outside the state. So if any for tax that has been paid in the foreign state, you won't be getting a deduction of it, but you will get a foreign tax credit of it. So the next slide, please. So here are the key corporate tax compliance that is required to be done by each and every entity in line with the what are the corporate tax law implemented in UAE. So the first thing is the corporate tax registration. Each and every entity in UAE needs to obtain a tax registration number in the prescribed form and manner. This is separate to the VAT registration number which the company might be having, and there is no threshold limit prescribed for seeking the registration, which means every taxable entity is required to be registered in the UAE irrespective of the threshold prescribed therein. So there are certain things like small business relief that has been prescribed, for which a threshold limit of 3 million has been given. If you are having a 3 million turnover, you are not required to pay any tax, but still the corporate tax registration is required to be taken. There are certain entities for which the corporate tax exemption registration exemptions are there, and which are basically the government entities, but all the business entities, irrespective of the fact it's a loss making, it's profit making, it's in free zone, not in free zone, all are required to take the tax registration. And the Federal Tax Authority has also launched the Imara tax platform, wherein an entity can take the sumoto registration after providing the relevant documents that are required to be done. However, as per the corporate tax law, what it has been specified that the registration needs to be taken before the first due date of filing of the tax return. So the first due date of filing of tax return for entity for foreign financial year as January to December is 30th September 2025, and the corporate tax registration may be obtained before that. But however, the FTA is encouraging, that it's encouraging sumoto registration, because of which it's also sending invitation emails to the clients to do the registration. So what we suggest that before the client is doing parallelly, it should also get an impact assessment done, so that it is clear as to what are the way forward that needs to be adopted in order to have a tax compliant way to move forward, so that there are no risk areas which can attract potential disallowance in the future. Secondly, tax return. All the UAE businesses are subject to the corporate tax are required to file a tax return in the prescribed form and manner. The form and manner is not yet prescribed, but the same will be prescribed in the due course of time. And the tax return needs to be filed by a taxable person, like for intakes or in case of a tax group, it needs to be filed by the parent entity, and the form and manner is yet to be prescribed. Further, along with the tax return, there is also a TP disclosure form that is required to be filed. This TP disclosure form contains the list of the list of the transactions that a company undertakes with this related party, and again the form and manner of it is still need to be complied. So along with the tax return, a TP disclosure form is there. And from a TP documentation perspective, recently there has been a ministerial decision which they specifies a threshold of 200 million dirham for maintaining a TP documentation for local file and master file. So now, although there is a limit to the documentation that needs to be made from a TP perspective, however, the all the transactions with related parties needs to be benchmarked as the arm's length pricing, and that continues to be there. It doesn't mean that if an entity is not having 200 million dirhams turnover, it's not required to have the TP policy in place. All those the TP transactions with the related parties still continues needs to be there at the arm's length pricing. However, the only thing that is there is from a TP documentation perspective that ministerial decisions clarify. The record keeping. So as specified earlier, the record keeping is of 7 years from the end of the financial statement, so from the end of the financial year. Then the tax audit requirement. The tax audit is also financial statement needs to be there as per the applicable accounting standard, and it needs to be audited. So the audit requirement has been specified for a free zone entity and for entities having turnover of more than 50 million dirham, which we will take later on in a detailed manner. Also, like the corporate tax payment, the payment of corporate tax needs to be made before the due date, before the due date of the filing of the tax return. So the corporate, there is no advanced tax over here like we have in other jurisdictions. It's just the annual compliance right now in this case of return of income, or also the annual payment of the corporate tax that is there. Next slide, please. So what are the practical challenges? These are certain practical challenges that a company face. Basically, how the allocation of expenses needs to be done to exempt and non-exempt income, bifurcation of expenditure to capital and revenue, how the foreign tax credit needs to be claimed, because you need to have a proper, many a times what we have seen that the clients do not have the certificate of the deduction of tax in the foreign country. So that again becomes a challenging. If your tax is withheld in a foreign country, have the foreign withholding tax credit certificate so that you are able to claim that in the return of income. Because for every entity, like a judicial entity or juridical person incorporated in UAE, the global income is taxable, and whatever tax has been discharged in a foreign country, the full credit of that is provided in UAE. Rules for determining commercial expediency of expense. Whatever, there should be a proper protocol that a company should be in place, that when it is booking the expenses for and any expenses or personal expenses then in nature shouldn't be allowed. Interpretation and implementation of GAR. Now, this is very interesting. Like, although we have heard a lot of requests from the client that they are trying to get a restructuring done, saying that, okay, my corporate tax is going to be implemented from 1st January 24. Let me undertake some sort of restructuring exercise so that I can save some bit of tax. But again, under Article 50 of the Corporate Tax Law, it specifies clearly that if an entity undertakes any restructuring exercise in order to take a corporate tax advantage, that will be like disallowed by the tax authority. And the implementation of GAR is not from 1st January 2024 onwards. The implementation of GAR is from 25th of October 2022. So as we stand, as under the GAR provisions are still effective, and the company needs to be very mindful of whatever restructuring exercise it is undertaking, because although the word being used over here is a tax advantage, unlike other jurisdictions where the word tax evasion has been used. So anything needs to be company needs to be very critical of whatever activity or transaction it's undertaking. The meaning of the qualifying income and adequate substance, as you must be aware that under Article 18 of the Corporate Tax Law, a free zone entity may be a qualifying free zone and 0% corporate tax rate is applicable to it in case it's on qualifying income and it has got adequate substance in UAE. And all the tax professionals now are eagerly waiting for the meaning of qualifying income and adequate substance to come. And we believe that the same clarity will be provided by the FTA during May because the corporate tax will be applicable from 1st June 2023 onwards. And further, like when you are talking about adequate substance, we need to be very mindful that the company has got the adequate employees, adequate assets and whatever things are there in place, and it's not just using the entity as a means of booking the transactions, and it's just not the entity on paper, so adequate substance is there right now. And earlier for the free zone, there was a thinking that there needs to be dual license for a free zone or for when you are functioning in the mainland. But now, as we understand that those things have not been provided in the corporate tax law final version, so even if an entity can have both mainland and free zone activities sitting down in free zone, what will happen that for the transactions or for whatever thing is falling in the qualifying income, you don't pay tax on it, and for non-qualifying income you pay tax at the rate of 9%. And a very important part that for 9% corporate tax for the non-qualifying income, the 3,75,000 dirham limit is not applicable. So rest of the amount, whatever you are receiving for non-qualifying income tax, flat tax at the rate of 9% shall be applicable. Depreciation tax rate not specified, so we still are waiting for depreciation tax rate that are there. So until and unless we get a clarity, so whatever the tax rates are mentioned as per the accounting standards, those will be admissible for the purpose of corporate tax law as well. Next slide please. Next slide. I can see a lot of questions coming up. Yeah, we will definitely take that those things in the later part. So the tax group. So under Article 40 of the Corporate Tax Law, a provision of tax group has been specified, which says that if an entity is having a parent entity which has got 95% or more share capital, voting power, then following certain amount of conditions that are prescribed therein, like it's following the same financial year, the accounting standard is the same, and it's prepare a consolidated financial statement, then the tax grouping provisions can be implemented, and the parent entity would be considered as the single taxable person, and all the tax obligations are required to be discharged by a the parent entity that is there. So there is an application that is required to be done or made to the tax authority. Where now an important point is there whether a foreign juridical person can claim, like we have been saying that the foreign companies are also over here functioning through a branch and all, whether those tax groups can be formed. No, the tax group can only be formed by resident juridical person, and there are a lot of benefits when you are forming a tax group vis-a-vis. Also the challenges are there that when you are having a tax group, suppose there are 10 entities and you are forming a tax group, so whether the 3,75,000 dirham limit would be applicable for each of the entity, but those limit will be applicable only once you are forming a tax group. So you are devoid of the limit of 3,75,000 benefit for each of the entity that are forming a tax group. But yes, those there are certain benefits of it also, because if you are doing if the entity which is having a law tax loss, those can be offset with other entity in a tax group. Further, whatever the transactions or movement of assets that are taking place within a tax group, so there would not be any tax on it. So a company may form a tax group, but again those things needs to be critically analyzed, and whether or not to move with a tax group, that needs to be done only after the making a detailed assessment of the operations of the company and what the company really wants to it. And also the free zone entities are, if the qualifying free zone entities are there, they are not allowed to form a part of the tax group. That again will be separately separate part of that, not part of the tax group. The next slide please. So we have been facing an issue that question that whether entity having multiple entities, but whether a single shareholder having multiple entities, sole proprietor, and like a sole, there is only a single shareholder in multiple entities, can those form a tax group under Article 40? So a very important question over here is that the concept of immediate parent entity has been prescribed under Article 40. So parent subsidiary relation should be there. A single owner cannot form a tax group. There needs to be a parent entity which needs to hold the entities near down to it and fulfilling the criteria of 95%. Only then a tax group can be formed. A single owner having shareholding in different entities, they cannot form a tax group. Next slide. Now I'll ask my colleague Rakesh to pitch in and explain regarding this particular part of the.
Thank you, Rohit. So this is a very important concept in international taxation. What is the significance of P? So P is to determine whether the contracting states has the right to tax the profits of a foreign company. It is very crucial in determining whether the foreign company must pay tax in the source state. For example, if there is a company overseas who is dealing with UAE or has an operation in UAE, and the overseas entity is earning profit from UAE, the UAE will have right to tax the profit only if the overseas entity has a P in UAE. So it is a very important concept, and with the onset of this new UAE corporate tax, and more so since the UAE corporate tax has a specific article on PE, it is very important for the business established outside UAE but dealing with UAE or having an operations in UAE to evaluate whether there is any PE exposure on the foreign entity. What if there is a PE in India, sorry, PE in the UAE? The implication would be there would be an attribution of profit to UAE. You will have to pay tax on the attributed profit. You will have to get tax registrations. You will have to file return. You will have to maintain documentation, so on and so forth. Let's take an example. There is a overseas entity who has deputed its employee to the subsidiary in UAE. And this employee is performing certain services for the overseas entity while sitting in the uh, subsidiary company's office. It is very important to analyze P in such cases. If the subsidiary, let's take another example where the subsidiary company is performing marketing support services. They are negotiating, they are concluding the sales. It is important to evaluate P exposure for the overseas entity in such cases as well. So every company need to revisit the business operation. Every overseas entity needs to revisit the business operations, because if there is a PE in UAE, there are related compliances which needs to be undertaken. Next slides. So I'll quickly touch upon the taxability of free zones. Although we are awaiting clarification on various fronts, like there is no clarity on adequate substance, there is no clarity on qualifying income, but whether to opt for qualifying free zone or whether to be a qualifying free zone and to be taxed at 0% is very important. So the fifth point is of utmost important, whether you pay tax at 9% or whether you opt for 9% or you pay tax at 0%. This is crucial because in certain holding company jurisdiction, if the subsidiary does not pay tax in the subsidiary company jurisdiction, there is a law that the holding company will have to pay tax on those income of the subsidiary in the holding company jurisdiction. And if your holding company jurisdiction has a higher rate of tax, then there will be a cash outflow to that extent. So in such cases, you will have to evaluate whether you need to pay tax at 9% in the source jurisdiction, that is UAE, or you have to pay tax in the holding company. There are various similar circumstances which you have to evaluate basis the facts and circumstances of your case. The second important point is maintenance of adequate substance in the UAE. Before before waiting for the clarification, you yourself needs to evaluate whether the company is performing activities for which it has been established. If your company is performing activities with adequate employees, adequate assets, adequate floor space, then it will be relatively easier for you to justify before the FTA that I have adequate substance. Second point on the compliance with TP provision. So free zone, if they are dealing with the related party, they have to comply with the transfer pricing provisions. Financial, as a third point, financial statement to be audited, there is no prescribed threshold. Qualifying free zone has to get the audit done without any threshold. Fourth point is very important. If the qualifying free zone earns both qualifying income as non-qualifying income, whether you have appropriate system in place to bifurcate or allocate the expenses which pertains to non-qualifying income and qualifying income. This in this scenario, tax technology will come into play. You need to have proper system in place so that proper bifurcation would be there. With this, we move to the second part of the webinar on ESR, and I would request Aditya Bhatia to take over. Thank you.
Thank you, Rakesh. Hi, everyone. I am Aditya Bhartia, and in this part of this session, I would be talking on the Economic Substance Regulations, or the ESR. So with everyone's attention or focus around the UAE corporate tax, one must also ensure that they are well compliant with the already prevalent regulations in the UAE, and one of them being the ESR. So to quickly give everyone a brief, ESR is applicable to all type of licensees that carry out relevant activities in the UAE. So it doesn't matter if you are registered in the mainland or the free zone. If you carry out relevant activities as per the regulations, then you will have to comply with the compliances such as filing of notification and filing of return. So it is very critical. The first step is to analyze that whether you are carrying out such relevant activity. So for example, an entity holding shares of other entity may or may not fall under the relevant category of holding company business. Similarly, an entity providing services or importing goods may fall under the relevant activity of service and distribution relevant activity. Thus, it will depend on the organizational structure, your group structure, your transactions to understand whether ESR is applicable to you or not. The important part here is that the applicability is so comprehensive that the position adopted in the previous year may not be blindly followed in the current year as well. It is very important that you reanalyze the applicability in the current year as well, basis the facts and circumstances of the current transactions of the current business. I can quickly give you an example. So suppose in the previous year, the ESR notification was filed, but since there was no income, the licensee or the entity that did not file the ESR return, they blindly follow the same approach in the current year instead of reanalyzing. However, they have actually earned relevant income in the current year. So this is blindly following the assumption of the last year or the stand taken in the last year, and not reanalyzing can lead to misinformation or incorrect filing. Similarly, suppose in the previous year, one had filed the return under the relevant activity of service business or headquarter business. But in the current year, if you reanalyze, you would come to know that you are providing other services as well, because there is a change in business circumstance, because there is an additional transaction which is not one time, or maybe you have owned IP and you might fall under intangible property business. So thus it is very critical that periodic or a yearly analysis is done to ensure that the filing done is correct, and there is no repercussions later on. Next slide, please. Thank you. So once you know that the ESR is applicable to you, you have to do a twofold compliance. First is to file the ESR notification within 6 months of your financial year end. For financial year ending December, the due date is June 2023. And the second part is to file the ESR return within 12 months, which would be December 2023. So in the return, you will have to give details about the 3 tests which are specified in the regulations. I mean, you will have to prove that you have complied with 3 tests in the UAE. First of them being the core income generating activity, or we call it SIGA activity. It is, in simple terms, it is the critical activity that an industry or that entity is undertaking in the UAE to showcase that the income that they are generating from the activities is having nexus to the activities that they are performing in the UAE. You know, it is not just a paper company, and you are actually providing some activity which is critical to generating such income. So there is no exhaustive list that is provided. It is an inclusive list that is provided in the regulation. So for example, if you are providing a headquarter activity, then one of the relevant activity could be providing senior management services, or incurring expenses on behalf of the group company. But if you are providing any other services through which you are generating income, you have to specify such activity which can be considered during the ESR return as well. Second test is the directed and managed test. So, you know, from the logic that the main reason of one of the main reason for introducing ESR is to ensure that you're actually conducting activities in the UAE, you are taking business decisions in the UAE, and you would agree that without a proper management, it is very hard for a business to function. It is very hard for a business to prosper, to grow, or to generate profits. So in similar lines, the next test is to ensure that you have proper directed and managed test in the UAE, which means that you have adequate number of directors in the UAE. You have adequate number of board meetings in the UAE. The quorum should be physically present in the UAE. The minutes, the documents must be signed. The directors must have adequate knowledge. And see, the number of minimum board meetings is not specified in the regulation, but again, it will depend on your business, on the uh, uh, transactions, or maybe if there is any change in the scenario in the business, then at least that must be is recommended to be documented in a proper form. Third part being the adequacy test. So in similar lines, to conduct business, you need to have adequate employees in the UAE. They must be physically present in the UAE, and there must be adequate assets through which you are providing services possibly, or which is assisting you to generate income, or providing the services or the transactions that you are undertaking. There must be adequate expenses. So without expenses, there is, I mean, it is very difficult to generate revenue. So logically, if you are conducting businesses, then the appropriate transactions must be there in the UAE. What we have been experiencing is that many entities, they file ESR return, they do not maintain a proper documentation, but when a notice is received, the authorities are sending a very exhaustive list of notice where they are asking details about the SIGA activities that prove that I mean, what core income generating activity you have performed in the UAE. Kindly provide the evidences regarding such activities. if you have employees, then show us the employee contracts, their visa, the expenses incurred for them, the copies of the assets. And also one thing that I want to highlight here is that in some cases, the authorities have also visited physically the office of the licensees or the companies. So it is very critical that this aspect is critically analyzed, and the documentation or the proof of the substance is maintained by the entity well in advance. Next slide, please. So like I mentioned before, the compliance requirement is twofold. The notification needs to be filed within 6 months from the end of accounting year. So for financial year ending December 2022, the due date would be June 2023, and subsequently the return filing due date would be December 2023. So one of the major reason that an entity should also comply with the regulations is due to the huge penalties that is associated with the non-compliance. As you can see that the penalty ranges from 20,000 dirhams, which can go as high to 4 lakh dirhams. So failure to file the notification or failure to submit the report can lead to penalties upon from 20,000 to 50,000. Also, if you can see the line item 2, the failure to file incorrect particulars. So suppose you have filed your ESR return under the relevant activity of headquarter business, but during the assessment or during the notices, it is seen that you have not provided only headquarter businesses, or you have not provided headquarter businesses at all, but you are falling under service category or service business. Even then, there is a possibility that you might be levied a penalty of 50,000 for filing inaccurate information. Thus, you must have a critical analysis of your business activities, and it is not a one-time activity. So it is necessary that if even if there is a slight change in the business, you must have a reanalysis, or the simple reason that I mentioned, that in the previous year you did not comply with the regulation because you did not earn any relevant income from such activity, but in the current year you are generating relevant income. So even these things needs to be analyzed, and thus you must not blindly follow the analysis or the stand taken in the previous year in every year. So to conclude with, it is I mean, the due date is fast approaching, which is June 2023. So for the entities that has not never done any analysis, it is high time that you have at least an analysis of whether you are falling under the ESR regulations or not, to save yourself from future penalties or other repercussions. Or the entities that have already analyzed the ESR applicability in the previous years, it is recommended that you reanalyze for current year as well. So that's it from my end. I would leave the webinar to Nishant and Rakesh.
Uh, Thank you, Aditya. Now Nishant will take the questions. Nishant, if you have any questions, we can discuss.
Uh, Thank you, Rakesh. Good morning, everyone. Thank you for joining the webinar. As expected, we have received a lot many questions. In interest of time, we will try to take up as many questions as possible. Rest, we will be answering on a one-to-one basis after the webinar. So first question we will take up. The question is, we are a free zone company. whether is it mandatory to audit the books of account? Rohit, can you take up this question, please?
Yeah, sure. Thanks, Nishan. So, as per Ministry Decision number 82 that was released by the FTA, so the audit requirement is there for a qualifying free zone person. Each and every qualifying free zone person needs to have its books of accounts audited. And what is the qualifying free zone person? Is again refers to Article 18 of the corporate tax law, which talks that if the free zone person is going or opting for the 0% corporate tax rate and specifies the or fulfills the conditions specified in the Article 18, then yes, its books of account needs to be audited.
Thank you, Rohit. We will take up the next question. The question is, where tax group revenue above the threshold of AED 50 million, whether such tax group require a audit is accounts through though individual member of the group is below the threshold limit. Rohit, if you can take up this question, please.
Yeah, so audit requirement is there entity wise. So a view can be taken that each entity having less than 50 million of the turnover would not be required to get its books of accounts audited. The members of the tax group would not be required. However, the parent entity, because the books of accounts are consolidated at the parent entity level. So if the parent entity has got the revenue beyond the 50 million threshold, the audit is required to be done of the parent entity. And so that is a view that's coming as per the interpretation of the ministry decision now.
Thank you, Rohit. Next question, I will read the question. Whether first tax period after incorporation of the company can be extended to the 18 months. I will request Rakesh to, Rakesh, can you take up this question?
Sure, Nishan. Nishan, the first tax period.
Thank you, Rakesh. Next question, I will read the question. Whether business opting for a small scale relief need to be registered for the corporate tax? I will request Rohit if you can take up this question.
Yeah, sure. So as specified earlier in the ministerial decision for the small business relief, what has been mentioned that they are not required to pay tax on their taxable income. However, the requirement of registration, filing or the return of income is still there for the small taxpayers, because on the basis of the return or the financial statement that the tax person will file to the tax authority, they will also see whether the 3 million turnover is right or not. So yes, the requirement of obtaining registration, return, and books of accounts is still there for the small taxpayers.
Thank you, Rohit. I will take up the next question. I will read the question. Is there any cap for the payment of salary to the managing director? I think you take up this matter while webinar, but if you can draw more light, Rohit.
Yeah, so as per article as specified earlier, as per article 171 of the company law, like there is a threshold limit specified that up to the managerial remuneration should not reach 10% of the net profit specified there in the company law. So however, though these things needs to be taken into account that first of all, you're not breaching the threshold limit of the net profit that is specified in the company law. Also, the second thing is that you need also needs to be whatever payments you are making, that again needs to be benchmark as per article 36 of the company of the corporate tax law. There are two twin reference points when it comes to the managerial remuneration. One is the company law threshold, and other is the corporate tax law threshold or the corporate tax law 36 article that has been specified there.
Thank you, Rohit. I will be reading the next question. Question is, we have received the notification from the FTA for the registration. We are a LLC company. Whether we need to register now or we can register later. Rakesh, if you can take up this question.
So the registration is open for all the companies. They can register it now.
Thank you, Rakesh. The one follow-up question, whether we are a free zone company and we are planning to opt for a qualifying income, whether we will require to register our company. Rakesh, if you can take up this as well.
I think there's some audio.
Yeah, Rohit, you want to add?
No, we couldn't hear Rakesh actually.
Now the question is whether free zone company we opting for the qualifying income, whether such a free zone will require to register under corporate tax. If
Yeah,
Rakesh,
so as specified earlier during the presentation that each and every entity in UAE needs to obtain the tax registration from the FTA, irrespective that it's a qualifying free zone or a non-qualifying free zone person.
okay, thank you, Rohit. In the
So
interest of time, we will be answering the rest of question on one-to-one basis after the webinar. Thank you for joining the webinar. Over to you, Rakesh. I think Rakesh have some.
yeah,
Uh, so Rohit, can you conclude?
Yeah, so I would like to thank all the participants for providing their valuable time in taking some time out and hearing out and to us. And I think this particular webinar would be very much important considering that the 1st June is approaching near. And I hope all the participants have found this helpful, found this mentally stimulating, and we would await their feedback by way of, we would be sending the feedback mail and it await their feedback as well. And happy to connect separately for any further clarification or information that is required. Thanks a lot. Have a great day. Bye-bye.
Thank you.
Thank you.
Thank you. Bye bye.